Today's Talk About It Tuesday question is, when it comes to investing, I'm very confused about what a good return on investment is. How do I know what a good return is? And how do I know how long it will take to double my money? Great question. I think a lot of people not only have this question, but also have a very unrealistic expectation of what a return should be or could be. And I think people have to understand that investing is about playing the long game. You know, it's not about, what I can get tomorrow. It's about allowing for this compounded growth through your investment. So let's just get real basic and let's compare certain things. One thing we have to understand about the economy is that no matter how good or poorly the economy is, inflation is a constant. We will always have inflation. So if we look at the average over many years, we will average between 2 and 4% inflation annually. That means every year, the cost of goods and services will go up between 2 and 4%. Of course, there are anomalous years like when we had the COVID crisis and we saw close to 10% inflation, but those are rare occasions. On average, between 2 and 4%. That is important to understand because at least with your investment, you don't want to lose value, right? So that means at minimum, your investment should be paying between 2 and 4%. I say 4% minimal just to maintain the purchasing power. That means that's your break-even number. 4% is your break-even number for any investment to maintain the value of your money, not to necessarily see growth. So the next part of this is that we cannot separate risk from return. It is a fact that the lower the risk of the investment, the lower the return on investment. So let me give you some examples. And the opposite is true. The higher the risk of investment, the higher the potential returns on investment. So again, some examples. If we look at a traditional savings account, we're talking about between 0.5% maybe, if you're lucky, to a high yield savings account of maybe 4% if you're lucky. So there is zero risk with a savings account because it is FDIC insured, up to a certain amount, obviously. So there's zero risk, but the return is on par with inflation. So you're not going to necessarily gain. Bonds are even worse. There is a fixed return at a fixed time period, but the returns are probably even less, maybe 3%. Maybe you'll get 4%. So again, on par with inflation. No gain, but no loss. Now, when we start talking about the stock market, individual stocks or funds, between 7 and maybe 12% over the long term. Greater risk, but greater reward. When we talk about real estate, pretty much the same thing, maybe between 6 and maybe even a little higher, 15% over the long term. So again, greater risk, but greater potential reward. So when we look at entrepreneurship, it's even greater. We're talking about perhaps up to 20%, but businesses fail all the time. So the greater the risk, the greater the reward. So now let's talk about the other part of the question. How do I know how long it will take my money to double? Well, there's a simple rule we call the rule of 72 when you're dealing with, investments. The rule of 72 states that if you divide the rate of return into 72, so 72 divided by, so let's say you got a 10% return. 72 divided by 10 means your money will double at 10%. Your money will double in 7.2 years. If it was 8%, right? 72 divided by 8 is 9. It will take 9 years. So whatever that number is, if it's, again, 6%, it'll take 12 years. Whatever that number of your return is, If you divide 72 by that, that will tell you how many years at that rate of return it would take for your money to double. So that part is easy. Finding the right investment that suits your risk tolerance and your needs, that's the more challenging part. So pretty simple. We have to beat inflation, right? Because we don't want to lose money over the long term. We have to mitigate risk by, again, I say diversifying. Don't put it all into one type of investment. You maybe have some in the stock market, some in real estate, some in fixed interest income, and spread that out so it averages maybe a little less than what you would get on the most risky thing, but it gives you more than what the least risky thing is as well. And then the doubling, like I said, is simple. Use the rule of 72. 72 divided by what your average return is. That tells you how long it will take your money to double. Love to hear your thoughts on this, but please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.